the military, you're really taught like an 80% solution executed violently now is better than a 100% solution in the future. It's always fascinating to me when I hear people like, oh my God, it's like so stressful. And I'm like, nobody's gotten shot. Like, this is actually not that bad, man. Like, I get losing money's not fun, sure. But we're going to be here tomorrow and we'll be able to sort it out. I started with such a small amount of money that some of these stocks, even over a 6-month time frame, they were flying. And, I'm seeing these returns, it's like really good percent returns, but then it's like $2. It's like you have nothing to show for it. Trading is, I always call it like the hardest easy money you can find, because once you build something that's sustainable, it really isn't that difficult. But getting to that point, that's where all the work is.
Hi, everybody. This is Boris Schlossberg. Welcome to another episode of the Trading Battle. Today, we have a really great guest with us. We have a gentleman by the name of Erik Smolinski, who is essentially one of the great stories because he's a truly self-made man. He came completely out of nowhere, has never really, didn't have a really big background in finance, and has been able to succeed in the markets, I would say, definitely beats probably his own wildest dreams, but certainly beyond most people's wildest dreams, and has really taken his approach to succeeding in the markets and was going to share with us some of the great ideas that help them really, really trade well. So welcome to the show, Erik. Nice to have you. You have a sort of a very interesting story because you come from a military background. You were a Marine. I've always, I have several friends who were Marines who are traders, and I always find that I don't know why, but Marine training seems to just produce some of the best traders in the world that I've known. Also, some of the best gentlemen I've known, because Marines generally have always been their word is their bond. And actually, I wonder if you share that idea and whether you think that your Marine training was a core help to you in becoming a good trader.
It's an interesting question because I feel like most people's experiences can teach them things to make them better traders. Like if you learn how to adapt them, right? Like I could think of that for pretty much everything. But one of the coolest things about the military is that it teaches you a couple things at like a very high level that you don't necessarily experience like other places. Things like execution. It's really high stakes typically, and you learn to execute in those kind of environments. So when I look at the markets, it's always fascinating to me when I hear people like, "Oh my God, it's like so stressful. It's so stressful." And I'm like, nobody's gotten shot. Like this is actually it's not that bad, man. Like I get losing money's not fun, sure. But we're gonna be here tomorrow and we'll be able to sort it out. I really do think in that context, it helps a lot. And then also maybe two other things: planning, because on the Marine officer side, you're bred to be a planner. You're literally bred to think through things and then to create something that you can action. So it's like that whole life cycle. And a lot of people don't necessarily get that experience at a normal job. They might get like a piece of a work stream and then have to execute on that. And then I would say the last thing is just getting good at operating in ambiguous environments. I always think trading is, I always call it like the hardest easy money you can find, because once you build something that's sustainable, it really isn't that difficult. But getting to that point, that's where all the work is. And there's always times where you'll see things happen that you can't really you can't explain all the way, right? Traders, a lot of times they'll start from the point of, oh, why did this move happen today? Why did this happen? And, the finance media, they're so good at giving like a one tag headline, Trump did this, or Powell did that. And we forget that the markets are so much more complex than that. That one line item sometimes could be a primary driver, but a lot of times it's just some sort of superficial talk line. And you have to get comfortable operating in a system where you're not always going to know why something went up or why it went down. And that's really challenging, I think. And the military helps with a lot of those kinds of things.
Yeah. So, you were talking about this, and I just reminded that one of the greatest trading books ever written is a book called Pitbull by a guy named Marty Schwartz. I don't know if you're familiar with it at all. He was a trader. He was really sort of like the first great screen-based retail trader. He was a Wall Street analyst. Then he became an options trader on the American Stock Exchange. And then he was one of the first people to move upstairs onto the screen and basically traded from his home in the 80s. So he was way, way ahead of his time. But the thing about him that's fascinating is that he was also a Marine. And he talked about his Marine training in the book. And one of the things he was talking about is that The key thing about being a Marine is that when you are encountering ambiguous situation, you cannot freeze. You have to act, move and act. And I thought, and I remember a couple of stories he discovers about how, like, if you're trapped in a bad trade, you have to just get out of it. You can't just freeze and hope that it gets better. That this whole lessons that he learned in the Marine Corps of just not freezing under pressure was critical to help him survive. It just made me realize that that's probably one of those skills that you probably have possessed. You probably don't even realize it because it's so inbred in you at this point, right?
Well, the funny thing about that is I spent a lot of time because in my undergrad and grad, I got into the stat side of things and just general research. And I spent a lot of time trying to understand the general condition of traders, just writ large. So not just from books, but going on to places like SSRN, the Social Science Research Network, and you just look up, papers. There's a great paper by Barbara Leonodine from California. I think they're from Berkeley, and it's called "The Behavior of Individual Investors." And in that paper, they talk about a highly documented effect called the disposition effect, and it's the propensity for traders to cut winning trades too short and to let winning trades run too long. And we enjoy the sensation. Yeah, exactly. And we enjoy the sensation of taking a winning trade down, and we want to avoid the sensation of realizing a loss. And the story that you just shared with the book that you read is it's exactly that. In the military, you're really taught like an 80% solution executed violently now is better than a 100% solution in the future. So it definitely lends elements to that. Now you can't be impulsive and whatnot. That's a whole other bag, but it does offer a lens to think about and to counteract just something that's innate in all of us via the disposition effect for sure.
No, we trust me. I don't think anybody who's traded has not been subject to the disposition effect one time or another. Probably, I think, like, the greatest battle and mastery of trading is to actually get rid of the disposition effect one way or the other. And there's a lot of different ways actually to probably combat it. I'm actually curious, your solution to that. How, and I'm sure you probably, if anybody who's traded has held a trade too long, has let losers go too long. What have you taught yourself in terms of improving that problem in being able to solve it as much as possible?
It's super easy. A lot of the stuff that we'll talk about today that's so fascinating is like it's so easy. This stuff is really easy. But there's a difficulty. A lot of times, like simple things can still be quite hard. So when we think about our behavior around different trades, the sensation of should I take this off? Should I leave it on? Or should I cut this loss here? Should I give it a little time to rebound? Maybe it'll come back up. The way that I think about solving all of that is, again, going a little bit more to my background in terms of data analysis, just broadly. Like, I'm not a data scientist or anything. Again, just spent a little time in the stat side of stuff. And all I do is bucket every single market effect that I trade. I take the market effect and I turn it into what I call profit mechanisms. The profit mechanism is literally what is the component of a market effect that I think I can monetize. A great example of this, just to use one that's happening right now, is earnings. We're going through an earnings cycle. There's a ton of very specific behavior that happens to equities broadly through earnings. The expansion of implied volatility going into earnings release starting about 2 weeks out, the contraction of implied volatility post earnings release, the post earnings move catalyst on the day up or down, post earnings announcement drift. That's four effects on one catalyst. Now, if we take the time to study each of those effects and understand how they typically behave, you literally start making the decisions for yourself. So, for example, if I'm playing the post earnings catalyst move, meaning on the day, something gaps up and we're trying to play a continuation of the gap, something like that, I have metrics that tell me if something gaps a certain amount at a certain market cap, given a certain volatility input, on average, it moves X percent. That's what I'm looking for. X frequency. Sorry, go ahead.
So does that mean you do a tremendous amount of research on studying those effects? What do you
Yeah.
find that information? How do you quantify and qualify all of that information?
That's the work. So the way that you find it is either try to find a platform that has good data, or you buy it. So I spent a lot of time buying data from SIBO, which is super expensive, but I always viewed it as an investment. But the idea of like building the ship blind and saying, well, I'm going to trade this effect and who knows what's going to happen, that's really difficult to get something logical online fast enough to see a meaningful impact quickly in your life. The other thing that I would recommend that is simple is like, again, start with SSRN. Go to, it's free for everybody. It's Social Science Research Network. There's a ton of stuff on there. And just poke around and see what research exists. You'll come across a ton of different market effects that are robust, well studied, well documented, have a clear description as to why they exist, and have measurements. So it's not necessarily going to be directly representative to the market you might trade in, but it'll give you a starting point for sure. So yeah, those are a couple ways to go about it.
Interesting. Wow. I mean, yeah. I mean, um, it may sound like a daunting task to some people because it's it sounds like when you first started out. Let me back up on this. When you first started out, was this always a data driven approach that you had to the market, or was it just like, hey, have a hunch, bet a bunch, let me see how that goes?
Yeah.
Um,
Yeah.
tell me sort of how you stumbled into the game and a little bit about the journey.
So I started really young. I was actually still in high school because a teacher he introduced me to the concept of investing. He knew that my family didn't have money and stuff. So I was always trying to find ways to make money, right? Like I used to
Mm.
sell Christmas trees, I used to move shale for a dude, split wood, whatever it was, I was down to do the work. But I was just kind of saving the money. I didn't know what to do with it. I just knew saving at least was good.
Mm.
And he introduced me to the idea of investing, never literally never even heard the term, didn't know what it meant.
Sure.
And I went to the library and the lady was awesome. She walked me through, showed me a couple books she thought I should read. And in there I came across, I don't even remember what the book was, but I remember reading, and it's the base starting point for a lot of people, but it's like buy what you know. So at that
Oh, was
point,
that Peter Lynch? Was it Peter Lynch's book?
I don't remember. Yeah, I had like 4 books, 4 or 5 books that I was kind of poking through. I didn't really pay a lot of attention to even the accolades of who they were. I could have been reading complete trash.
One Up on Wall Street. I mean, that's a classic book, and he's of course a legend.
Yeah, that actually sounds because I that book
Yeah,
I know very
yeah,
well, and it
yeah.
very
Yeah.
well might have been that.
Peter Lynch produced 30% for like 15 years, and then
Yeah,
just walked away, which was like the greatest exit in investing history. The guy literally walked away from the top at the age of like 45 and never traded again. It was like,
smart,
yeah, it was just
smart.
the ultimate drop mic moment ever. Um,
Yeah.
so you got introduced to that. So invest what you know, and then what went next? Like, did you start looking at
Yeah.
things?
So it was at that point I was really excited about a company called Netflix. And there was another one that looked really neat because I did enjoy reading. It was called Amazon. And I thought that these little devices that could play music from a company called Apple were pretty cool. So I literally just started picking companies that I thought were neat, and a bunch of them started to meaningfully grow. The funny part is that any new trader can identify with. I started with such a small amount of money that some of these stocks, even over a 6-month time frame, they were flying. This was like 2007 before we had the actual crash. The stocks were flying. And, I'm seeing these returns, it's like really good percent returns, but then it's like $2. It's like you have nothing to show for it. So at that point, I was just like, this is going to take too long. And that's when the standard patience of a young man came through in shining fashion. Were really known for being highly pragmatic and patient. And I decided I need to trade. And that's when I came across options. And then at that point, the world was very different just with the way that the markets were, but more so in terms of information availability. It was very different than what it is now. Now I would almost consider it to be the stage of information overload. There's so much information out there that it can like literally overwhelm you. Whereas when I was starting, it was much simpler than that because that didn't exist. It was difficult to find stuff on options. So what you found, you read. And that's how I got introduced into derivatives. So this was, just a few months after I started that buy and hold investing, which wasn't working fast enough. And as always, to put a bow on that story, anytime I look at like what those stocks are, it would have been like a 10,000% gain on some of them. It's always looking back like sick. It's awesome.
Apple, Amazon. I would never have to work for us. Yeah, it's the woulda, coulda, shoulda. Argument, as we say in New York. If my aunt had something, she'd be my uncle. Um, uh, I was going to say, were you using options as a stock substitute at that point? Were they just sort of, or were you doing something a little bit more sophisticated as far as strategies? What were you doing?
Yeah, I really got into verticals pretty fast. And the reason for I really don't like verticals now in like
Well, that's
full.
interesting.
Yeah,
So
no.
why tell us, why you got into verticals first, and why you find them to be a lacking strategy now.
Um Verticals as an option structure, there's nothing wrong with them. In the beginning, the reason why I use them is because it alleviates a lot of the capital requirements for options. And with a small account, that's normally the case.
So just for some of our users, a vertical is basically an option where you buy a more expensive option at a lower strike price, let's say on the call side, and then sell a less expensive option at a higher strike price to finance some of that cost, and therefore create a kind of a spread that's much less expensive than if you were to simply buy the option outright.
Yeah, and the purpose of them is they help create a risk defined profile. So it can really alleviate a lot of the cost requirement. But the problem is then in that pursuit of alleviating some of the cost requirement, then you're obviously offsetting some of the gain potential. Once you overlay friction, that's not just the commissions you pay, but also on the back end of order execution, fills, spread, you can start giving up like a decent amount of money even on stuff that you're right.
Huge, huge. Like
Yeah.
just like I remember, just for I think for people, even the now it's gotten a lot better, but in the olden
Mhm.
days, if you're doing, let's say, a 5 point spread, it is absolutely, you would assume it would cost you half a point just to execute and commission that trade. On the inside, you'd be lucky if that was just going in and going out. So that's 10% of the value of the spread would just be just friction, as you said.
Yeah, exactly. So they're like suitable in the beginning. I think, I mean, if I were to start again, it would be a completely different approach. But at the time, I understood why I did that. But at this
Mm.
point now, especially as the account matures and whatnot, the cool part is it opens some different paths you can take to manage risk without having to necessarily have a direct hedge. Because that's another disease I think retail traders end up with is like where we want to hedge away all of our risk. How do I hedge this 5% drop? And it's like, listen, man, you just size it so that if a 5% drop is going to ruin you, it shouldn't, right? Like
Right.
you got, it's got to make sense because the
Oh,
cost of a hedge is not insignificant and it builds up over time. And it gets to a point where it's like, if I'm hedging everything, just buy and hold an index ETF. You'll get a better risk adjusted return, especially
yeah.
input adjusted return without having to do all this other stuff.
Yeah, that's very true. There actually, I was going to ask you that earlier when you were talking about you had all these different known effects in the
Mhm.
market, that I would imagine, given the fact that you're very statistically oriented, you probably spread your, like, in other words, let's say you're trading post event breakouts, or let's just the very common strategy, the gamma squeeze, when option with the volatility compression after news, right?
Mhm.
You probably trade 5 to 10 names. You don't just simply rely on one or two option positions to try to get profit, because the law of large numbers. You know that this is an effect that works on a big sample, but any one or two given stocks could actually go quite against you if you just simply put your money into one position. Is that correct?
In general, yeah. The way I look at it is, and this is why it's so important to understand the market effect, because different market effects have different profiles. The one you're talking about there, specifically vol contraction post event, it's a very grindy strategy. Like
Hmm.
there's periods where I'll have 30 of them on, overnight, for one earnings cycle. And that's like
That's
completely.
my point, that you would have
Yep.
like 30 different positions on. Yeah. So
Yeah,
because
and so
yeah.
for something that deals with vol in that way, that's very common, especially during the heart of earnings. There's other strategies that are much less like that. So if I'm trading some sort of catalyst breakout, normally that's like very specific. I
Yeah.
only have a handful of those that'll fit the criteria, or like post earnings announcement drift. That's another one that will weed out a lot of the potential earnings plays that actually exhibit the set criteria that I need to see for that to be
Hmm.
viable.
Yes.
So it does depend a little bit on what the effect is. but the like my overall book, it can ebb and flow massively depending on where we're at in a year for sure. Like, I mean, there's definitely periods where I'll have well over 100 positions, 200 positions has happened like not
Right.
too infrequently, especially during like a heavy earnings cycle. But more often than not, the typical carry positions is much less than that. I would say less than 25.
Interesting. Yeah. Yeah. And it makes perfect sense. But generally, you know, what, how did you build it? So you started with verticals. How did you then, what did you find that started to work for you? And how did you start to grow your account to a point where
Yeah.
you could expand?
I I think the main thing was actually like the biggest catalyst that caused me to take this thing entirely at like a different tenor is when I
Mm.
had the largest percent drawdown of the account. So I had a really wide iron condor, which for those that are unfamiliar, it's kind of like a bet that something's going to stay in a range,
Right.
and it was in the Russell index itself. And at that point, I had been trading for a few years, I have an obsessive personality, if you can't tell. So as soon as I started learning about options, and this was like when I was in college and stuff, so you have plenty of time, you couldn't pull me away from it. So I was spending hours and hours and hours. So,
Cool.
anyways, I felt that I knew something, aka for those that don't know, this is a preamble to the Dunning-Kruger effect.
Good.
And I was building this position in the rut, super high probability of winning. It's like I was trying to make like 500 bucks. And I was just so set on making this 500 bucks over a couple days. And I put the position on and it moves against me. And I'm looking at a significant drawdown on the portfolio that I just completely did not even think about. That this trade was going to be a 85% probability of winning. So why even look at that?
And right.
And I saw it happen. I end up realizing this has gone sideways. I took the trade down, realized the loss, and I was actually at the gym with my buddy I played rugby with, and I just remember I was like, I'm going to do the workout, kind of like let this digest, and then see how I want to proceed from here. So after the workout, I was sitting there saying, "It's like I could stop." But I don't think that I need to. I think that I need to take this way more seriously than I've been. So it was after that point that just about everything changed for me. I switched to documenting things. Before, I didn't have like a written trading plan. I didn't
Right.
have a built trading log for me to analyze anything. So I was like, of of course this wouldn't necessarily work out super great. Like, how could I have thought that this was going to have a different outcome after that happened? So it's like
Right.
that's the catalyst that really led to a big change, and those are the main changes I started implementing is tracking.
Interesting. Interesting. So basically, the drawdown, you were at that moment of true fork in the road. I'm either going to just quit or I'm actually going to take it much more seriously. And that change in attitude is what really created a much better behavior and trading habits. Very, very interesting. Most people, of course, are either just quit or refund the account, but don't do the same errors over and over and over again. Yeah.
I think there is a benefit to coming at this with a slight point of desperation, to be completely honest, because at this point I knew I was like I was going through college on a Marine Corps scholarship. There was no chance I would ever be able to afford college otherwise.
Right.
And like Marine officers, they do okay. They're not like destitute, but they're also not like rolling in money.
Sure.
And I knew that my mom didn't have a retirement. Like she was a contractor, like a physical therapist her whole life.
Yes.
So she worked at like, local schools. So it's like not private schools, public schools. So
Mm.
obviously not making money.
Yeah.
And most important, as a contractor, no retirement. So I really did like I knew well ahead of time, like, I gotta figure this out because she's solo. She doesn't have a husband at that time.
Right.
So to me, that was a big part at the end of this. It's like, well, I can do well in my career. I could probably help with what I make in the Marine Corps, but that's not going to position me to like make my life what I want and
Mm.
make her life what I want for her.
Right.
So that leads to an impasse, right? I'm not that good looking, so prostitution wasn't on the ticket for me. So I had to find something else. So
Um,
that's
yeah.
the route we went.
Yeah. That's amazing. No, it's really interesting. I think very few people actually take it seriously to succeed. So once you did, what were the sort of key like maybe 2 or 3 things that you started doing that radically changed and improved your performance within, after
Super, super simple. This is the kind of thing, like, if somebody does this, if you do it for a month, I literally guarantee it will make your trading better. It's unequivocal. Like, it is for certain. All I did was in the trading plan, I would write out the steps that I thought I should do. Then, as I would follow those steps to the best of my degree, I would then put it in a trading plan, or I'm sorry, in a trading log. I would like
you,
log the steps, and then I would actually log the trade that I put on. And then I would reconcile them. I would say, this is what I said I'm going to do. Did I do that here? Okay, I did. Great. I didn't. Why didn't I? And the most important part in this process, and this I genuinely believe is kind of like the ultimate unlock to eventually finding your way as a trader, is just an iterative process.
right,
If you do this enough, long enough, without blowing up, you are going to stumble across something that
right,
helps you. And
right.
it's literally just that. The problem is just none of us do it in the beginning for a bunch of different reasons.
You,
But
you, it's funny because it sounds like you just discovered a trading version of a Ben Franklin. Ben Franklin was notorious for, like, here's the pros, here's the cons of the thing, and with you, it's actually an amazingly brilliant idea of, like, just simply a T-shaped table where this is what I plan on doing, this is what I did, and then you just simply reconcile the two at the bottom. Very, very simple. Was this in handwriting, or did you like have a spreadsheet? How did you originally put this together?
it's funny because when I first started learning, I still have my OG. It was a binder because I'm also super anal about
Mm.
organization. So a
Oh,
notebook bothered me because as I would like have an idea, it wouldn't be in the right spot.
oh,
So I got a binder so that I can organize stuff that I thought was logical. And
right.
as I was doing that, I was like flipping through trying to find something. I was just like, dude, there's no control F. Like I can't
Right,
just find something.
right, right,
So
right.
I literally spent it was a while taking literally everything from that binder and then putting it in a Word doc so that I could
Oh, you
search it. So
hard
yeah.
coded with WordBack. Wow, wow, wow. What do you do these days? How do you maintain the process these days? Is there a software that you use, or do you use a spreadsheet? Like, how do you maintain sort of your trade plan to trade log?
Yeah.
Uh,
So the trade plan is now in Google Doc versus just a Word doc 'cause it's more mobile. It's easier for me to do
Wow, right.
things, yeah,
Interesting.
as I'm cruising around. And then I actually just made the transition from Excel into Google Sheets.
Mm,
Excel, I still use that more for the heavy lifting, like actual analysis, but Google Sheets is more for like the logging, tracking, stuff like that. I went through a phase where I actually built kind of a completely automated flow. So I would pull everything from the broker directly, upload it directly. I would have it parse out
right,
like what the strategy was so I can label it. And then I
right.
realized like in doing that, I didn't like it. It led to me getting just far enough away from what I was doing that I was
Yeah,
losing some of that, like, intuition where sometimes that
right,
I think sometimes we undersell how effective our brains are as, like, a supercomputer in terms of just process recognition and pattern recognition over time.
point. Right,
So, I noticed myself losing some of that.
right.
So, I went back to just manually entering. The thing about that is people always think it sounds like this insanely arduous process. And it can be if you have really high volumes, but
Mm,
I don't. And I think if you have really high volumes as a retail trader, you have to take a look at what you're doing because you are probably dragging an anchor behind you that you don't even know is there if you're transacting that much. But
right.
beyond that, I think the other thing when it comes to like that kind of approach is if you build something that's logical, it doesn't take much time at all. It
Yeah.
really doesn't take much time at all. And now you have all these different plugins. Like I have different macros that I can use to like automatically move stuff, delete certain sections so
Mm,
that I can input something else.
mm,
So the thing I would mention to people on that is it sounds kind of crazy, it sounds a lot, but it really isn't as much as you think it is. If you just start something, it's going to suck. And that's okay. You iterate on it over time, you morph it into what works for you. And
yeah,
that's literally all you have to do.
yeah. How many positions do you run a month, for example?
A month can be crazy. I normally think of it in terms of weeks. So
Okay.
if I
Yeah.
extrapolate that out to month, I would say over the course of a week, it can be really chill. Like sometimes it might be like 10, 15.
In a
That's
week. In a week.
yeah, in a week. That would be very much on the low side. Other times it can be multiple hundreds.
Mm.
So yeah,
Really? What
yeah, oh
what
yeah.
what makes a 10 position a week different from a 100 position a week? What?
A 10 position week is when I'm traveling and I am kind of setting everything up so that I don't have to touch it.
Right.
So I'm paring down all the momentum stuff. I'm not trading index vol. I'm not trading earnings. Like I'm taking all the book down.
Mm.
And I just have like a handful of carry positions that I might like, to maintain longer term. So yeah, that's anywhere like 10 to 20.
Mm.
And the reason why there's a lot of positions in a nutshell is because I do trade all different kinds of effects, especially during an earnings cycle. But beyond the earnings stuff, like I do trade different index vol. So there's zero DTEs and SPX. So that's a certain number of positions every single day by itself. Right. So it's not like this really crazy, super big number of like these extremely disparate strategies. A
Right.
lot of times it's like one strategy that might have a handful or
Five or 10
yeah,
trades and
exactly.
split it.
Yep.
Okay. So let's talk about that. I mean, that's, it's the flavor of the day. Everybody is involved in zero DTE.
Mm.
It's become the darling of everybody, it's getting insane to the point. Somebody was suggesting that the CBOEs is going to start doing hourlies, but I thought that's, if they start doing that, that's going to get crazy. But what do you find within zero DTE that seems to, what effect do you see there that seems to be exploitable? Um,
Volatility risk premium. That's the big one. So
okay.
volatility risk premium is when it's the propensity for implied volatility to be greater than realized. All that means
Right.
implied volatility in the options market
Right.
is the forward expectation of volatility that's priced
Yeah.
into options.
Right.
And realized volatility is simply like what happened in the past, backwards looking. And specifically in the indices, we can measure it, we can see it, where more frequently than not, implied volatility will trend higher than realized volatility.
Right.
And then you can double click into that because when we talk about that trend, IV over HV or RV, IV
Right.
implied volatility, HV historic
Right.
volatility, or RV realized volatility, kind
Mm.
of synonymous in this
Go.
context, we can measure it and then we can double click into it because that's looking at it at what we would refer to at the term level, the term being the expiration of zero DTE. You can then go into the vol for individual options and find individual options that are even more overpriced relative to the rest of this
Right.
stuff.
Right.
So it's mostly that effect. A lot of times it's also correlations between different indices. And then it's
Really.
also trading volatility products outright because they have a insanely interesting, for slightly autistic people like me, they have an insanely interesting behavioral pattern that you can trade across the volatility products themselves, but that's way more nuanced.
Interesting. So to sort of put this into more layman's terms, let's assume you have a straddle in the S&P,
Okay.
right? And the straddle says on the day of at the beginning of the day, it says that it's predicting a 0.5% move. Like the
Okay.
whole straddle is worth about 0.5% of the S&P. And historically that the historical movement of the S&P is maybe only 33 basis points, a third of a percent. That would be it's a very simplistic example, but I just want to give people an understanding what that means, implied versus historical. You would try to exploit that discrepancy by selling the rich implied on the assumption that it's overpriced, right?
Mhm.
And that it's too rich.
That's
But
exactly
of
right.
course, that's a very, very simple example. Please don't put that strategy into practice because you will get killed. Erik is working on that assumption, but he's going out to various strike barriers and seeing, oh, this particular strike is extremely more expensive than it should be. For example, the strike is predicting 1.5% move, and it's worth this much. And the probability of going 1.5% move to that direction is minuscule, maybe like 1 or 2% at all. So I may take advantage of that in small size. Now, when you do a lot of these vol selling strategies, you're naked. You
Mhm,
don't really you don't hedge. You hedge by size.
mhm.
Basically, I'm going to take a small enough position that even if it go, like let's say um, this particular strike price is predicting 1.5% move, and even if it goes to 2.5% move, the worst that I'm going to lose is this much money. That's the it's manageable in terms of my total portfolio
That's
risk,
exactly
right?
right. So what I do is I also do vol sampling throughout the day so that I can create different standard deviation projections. So
Mm,
I can even say like if there's a 5 standard deviation move, which is exceedingly rare, but if there is, the account wouldn't be happy, but it would be fine, right? So I very much in sizing that way.
you stress test your account basically on
That's
like
exactly correct.
what if we had a suddenly a 3% move
Right.
because I'm more Trump said tariffs going to 1,000% or
Right.
whatever like that. Who
That's
knows?
exactly right. Yep, that's
Yeah.
exactly right. And
Yeah.
the other thing to keep in mind too with just setting up risk control in this way is paying really close attention to correlation risk. What a
Mm,
lot of that it just gets slept on by so many people where they just don't really think about it. But if you're trading some sort of index vol in SPX, RUT, and Nasdaq, and let's say that you're playing different positions across one another where you think that there's a little bit of a balance between them.
right.
If there's some sort of crash, more often than not, correlations go into one, everything's dropping.
Correct.
So you kind of have to pay attention to those things too if you're trading index vol across different things that might even seem complementary
Right.
because in extreme environments, it could be super not complementary. And you
Right.
can look at it and be like, what happens?
So when you say correlation of vol, in other words, you may be long Nasdaq, short S&P, or long S&P, short Nasdaq, just as a as a correlation trade because you think that one is too expensive versus the other. Uh,
That that would be a little bit more of a pairs basis trade for me.
would okay.
The example that I was giving before is the same context, but looking at the volatility, not the price.
Okay. So, but I mean, let's say, for example, NASDAQ is inherently higher volatility than
Mhm.
SPX or RUT. Or I don't know about RUT because I don't really trade RUT, but
Yeah.
I know that, SPX and NASDAQ inevitably have. So, what would be the vol strategy between SPX and NASDAQ, for example?
Yeah, so you can look at the relative vols of them. So you might say to yourself, I think the vol in NASDAQ is extended to the upside, and I think that might contract.
Ah,
And
I
you
see.
might say, I think the vol in SPY, based on the normal relationship between these two,
Right.
is too low. And I
I
think the
see.
vol in SPY might come up. So you might play that
You might
normalization.
play a game. Yeah. Okay. That's interesting. That's really interesting. What are some of the some of your favorite stock market effects, I guess, is how it would want it, or be behavioral effects that exist in the market that repeat themselves quite consistently that you've had a chance to you either find really interesting or you find really interesting to exploit. Can you share maybe top two or three with us?
Easy. These are also super simple. The base definitely is what we were just talking about. A lot of this different volatility risk premium. That's absolutely a big thing that I do.
Yeah.
Momentum. Momentum is
Yes.
another
Oh,
massive element.
can you talk to us about momentum because
Of
that is a
course.
certainly that is a factor that I think probably has been studied more than
Yes.
any other variable in the market. And if there's anything that can be said with high degree of confidence that has been proven to exist, it's momentum. So tell us
Un-
a little bit about what you
I
find.
literally couldn't have preambled it better than that because that's the basis of it. One
Right.
of the things I think retail traders do frequently that really hurts their performance is they try to reinvent the wheel. They try to say like what's the best stock to trade options in or like what's the
Yeah.
best stock. And
Yeah.
it's like that's a tough way to go about doing this business. So if you start by looking at things that we know exist and it exists for a good reason, that's a great place to start. That's a great place to start. And momentum is
Yeah.
exactly as you described. It's one of the most documented effects that exist, and it will continue to exist, just like volatility risk premiums are going to be
Yeah.
there tomorrow, just as the sun is going to come up. So, the way to think about momentum is that there is a latency in information being priced into something. So, if there's a great release that comes out,
Mm.
that information is not immediately fully priced into that thing for a
Yeah.
bunch of different reasons. And this effect can be really stratified. We can go real deep on the effect, such as the difference in analyst coverage on the momentum factor and so on. But to
Mm.
avoid going that deep that quick, it's essentially the propensity for things that are doing well to continue doing well, and for
Right.
things that are not doing well to
Right.
continue not doing well. That's
Right.
it in a nutshell. If you've ever heard of like a sector rotation strategy, that's
Right.
predicated on momentum. If you think about the S&P 500 index, it's momentum. They drop the losing stuff and then they buy stuff that's doing well. That's momentum.
Oh, that's absolutely true. It's the S&P 500 basket is in fact the first example, the underlying example of momentum.
It is
Yes.
momentum.
Do
Yeah.
you think that's it? It's really a function of just crowd behavior. So you have a small group of people, let's say buyers, who influence the position of an underlying to the upside, right? And um, they have enough power to to move it up. And so then what happens is other people now see that this position is up. So people who are short, for example, are now forced to cover because the position is getting too painful for them. And people who are not long are kind of now becoming interested because, oh, this is moving, therefore it may have more potential to move. And then kind of like that small group of people becomes larger and larger and larger. And that is really what the function of momentum is. It's basically a greater degree of the market moving in the direction that momentum is moving until eventually it gets oversaturated and we have the counter momentum moves.
In that context, I would almost equate that more to like a gamma squeeze or a short squeeze, especially
Mm.
with the short activity component to it, which by the way is a market effect. It is a profit mechanism. You can trade those. They're really not that difficult to find. But when I think about momentum, I think of it more in the context of it's not just is this thing going up, but is there a reason why this thing is going
Well,
up?
that's what I mean. And
So
people discover they see it going up. They discover the reason. They go, "Oh, it's an interesting reason. Let me join." These other people, and then somebody else. Oh, I want to join him, and just sort of it's like the game of telephone. It's just sort of
yep,
like the last person hears about it and come in.
that
It's yeah.
I think that definitely is an element for
Yeah.
sure. And
Mm.
that also leads to short-term price distortion. This is why if you know the momentum factor, you know that there's certain look back periods that are stronger than others. We know 6-month, 12-month are stronger look back periods than 1 month. 1
Right.
month, 3 month have a high propensity for reversals. Why does that
Right.
happen? That exact component, things getting too crowded in the near term. So that's
Right.
absolutely an element. And the way to find momentum really changes a lot based on the way that you're looking to trade it. But the thing I would always give people to keep in mind is like if you look at something and you can say like, yeah, the momentum here seems justified. Its last two earnings releases have been absolutely awesome. It's raised guidance both times. That means something, right? That is going to draw more attention. It's going to draw institutional money because at the end of the day, that's mostly who's going to be moving these kinds of things
Right.
is trying to find the stuff that appeals to institutional money.
Yeah. And also, momentum in real life takes a long time. Like, my wife is a hedge fund manager, and she invests. She invests in a lot of retail stocks. Her long position for a long time was Crocs, right? And like the fad in Crocs, starts out with a few kids in the cities, and then it gets into the suburbs, and then it goes into the thing, and then eventually it blew up today because it kind of saturated itself. But the point being is that like in real life, things don't happen instantaneously. People in those fundamental trends then translate into financial trends because obviously earnings continue to improve over and
Mhm.
over. I'll make a personal confession here that the single greatest thing that improved my trading was when I finally stopped trying to short momentum or get long momentum. When I finally stopped trying to sell tops and buy bottoms was a huge improvement in my overall P&L.
It's funny too because we all do that. We all think that like being the contrarian is sexy or
Right.
smart, and it sounds so intelligent. But the funny part about that is like again, people who try buying dips, sometimes you find that it keeps on dipping, and it's dipping for a reason. And
Yes.
just because we think it's sold off enough ultimately doesn't matter in the least. What matters is what price is doing. So I think I absolutely identify with that phase as well. Like
Yeah.
especially just trying to sell options, what I would consider to be just outside where I thought it might, continue
Yeah.
to, and then you just see the short call get swallowed and you're like, this is kind of awful.
Right. Right. Um, if you don't mind, maybe you could share some of your screens with us
Sure.
and show us a little bit of some of the things that you're doing on a day-to-day basis. Maybe share an idea or two. I'd love to see it. Um, but
Beautiful.
while you're doing that, I will say this: that absolutely, talking about the idea of I have to get serious about this. That's when I think the reason we all like to buy dips and sell rips is because it makes us feel smart. But when you become serious about trading, you realize that it's about actually making money, not feeling smart. That you don't get paid. You don't get paid off in just being smarter than the crowd. You get paid off in actually doing things that work over time consistently, and
What
that took me time to realize.
what I
Uh,
like to tell people is, do you want to be right or do you want to make money?
yeah, and most people actually like to be. They'd rather be right than make money because
Exactly.
it's all complete ego.
The
Um,
exact ego is a drug. So
yeah,
yeah, let's talk. I mean, right now the earnings effect I think
yeah,
is really, really useful. So
sure. We're in the
let's
middle of the season. Yeah.
yeah, I think a really important spot to start with though is creating context. I'm really again, this is part of the Marine Corps planning process, the
Mhm.
orders process. We always
Right.
start with an orientation and a landscape analysis, like what's going on current day. So
Good.
stuff I like to use look for that super simple is this really hectic looking
Yeah.
series of charts. All
Right.
this is the S&P 500 and the component sectors. That's all. So
Okay.
it looks heavier than it is. So I have the indices up here, vol, bonds. Normally this will be either oil, gold, a lot of times recently Bitcoin because that's been on a tear, stuff like that, just something
Right.
outside the basket a little bit. And then these are just literally all the spider sectors. So technology, materials, blah, 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 blah. And then this is a really useful tool that I use in a couple different contexts. This is just the percentage of S&P 500 companies above a 50-day moving average.
Mm.
So it gives me context on just underlying breadth. And then the
Right.
other thing that you notice here is there's kind of like this net highs, lows combined. That's probably the other largest breadth tool that I like to use
Right.
is this right here. So what I do is I essentially plot out the NASDAQ and New York Stock Exchange, the exchanges themselves, and I track how many companies are making highs compared to lows, gross, and then net. The
Good.
reason why that matters to me is again for breadth. I like to know, is the market broadly supported? Is it supported by just a few names? It
Mm.
gives me a really distinct list of like shopping items based on that. So, yeah,
So
sorry, go ahead.
we've been in a market that's been incredibly narrow. In fact, probably one of the narrowest markets in the world. I think that's what's been really blowing people up is because they see most of the stocks are not doing well, yet the market keeps making fresh highs because it's being driven by 3 or 4 names: Nvidia, Apple, Google. We all know the names. So how do you deal with that dynamic, given how it's
It's
traded?
really it's actually simpler than might be expected because that sort of dynamic, like for example, if we actually dig into the performance on the year, I actually think you might find it's a little more spread out than you might think.
Really?
Because if we take a look at stuff like comm services doing well, but utilities is shockingly crushing it. Financials has stepped up massively. They're crushing it. So a lot of times I employ like a modified sector rotation strategy. This is more for my directional plays. For context, I split my portfolio into two buckets. I have a core allocation and a speculative allocation. For those that are familiar with military jargon, the core allocation is what I refer to as my main effort. And then the speculative allocation is a supporting effort. The way to think about that is the main effort is what I'm expecting to drive most of the returns. Sometimes it does, sometimes it doesn't, but that's how I'm weighting it. And then the speculative allocation is really designed to take these different kinds of shots based
Can I
on
just interrupt you and ask you, is what's the percent split between the core and the speculative in your portfolio?
it's a sliding scale. So the core allocation can literally be up to 100%. It can have everything. if the market environment is conducive. If it's not, then I scale it back. It'll pretty much never go below 40%. But like this is actually a primary market where the core allocation has been scaled back massively and the
Mhm.
speculative allocation has been widened out massively. And it's just
Interesting.
to adapt
Where
to
where are you now? Are you close to like 50% core, 50% spec at this point, or what?
I can actually tell you right now.
Approximately. You have to. I'm
Yeah.
just curious because it's essentially
So
in a way a comment on your view of market risk at this point.
sort of, yeah. So right now the portfolio is still slightly levered, but it's like 48% core.
Okay. All right.
So definitely light on the core side.
Yeah, right. So
Yeah.
you're lighting up on risk because you see lots of things as you were showing. There's breadth is lagging. There's probably um, other factors that are bothering you a little bit. Vol is certainly been low, right? Um,
The main thing is the pursuit of opportunity. So
mm,
with the market spends the majority of its time within 5% of all-time highs. So people that get, nervous at tops, again, this
right.
is why understanding like the statistical behavior of things is super useful.
Yeah,
Because
yeah,
if I see something near highs, to me it's like,
yeah.
yeah, I mean, I know it's going to
That's
spend
kind of
most
like,
of the time here.
another one of those studies that's really interesting is that a stock that makes an all-time high is usually one of the greatest investment,
Mm.
opportunities there. Typically, if it breaks to a fresh all-time high, the propensity for it to go much higher is much, much greater than for it to retrace.
Bingo.
Yeah,
And that's actually a key component of
yeah,
our friend momentum from before.
right, exactly,
Um,
exactly.
but yeah, it's the way that I adjust that slider really has everything to do with where am I seeing the returns on risk? So I still maintain long beta, so long market exposure. I actually even trade leveraged ETFs on those for a part of the portfolio. I trade an option strategy that I've built called a covered strangle. It's kind of like for those that are familiar with a wheel, it's similar to that, but it's
Where
slightly
so you're selling the puts, collecting the underlying, and then selling the calls, based upon your kind of volatility and directional view of the market. Is that sort
yeah,
of like
that's exactly right. So what I'll do is I'll cycle in and out of the equity component based on what the market is doing. The short puts go out at different levels,
uh-huh.
mostly based on vol. And then the short calls are always sold at a ratio against the equity. If I have no equity, there are no short calls. So the purpose of the ratio for those that are familiar with covered calls, if I have 100 shares and I sell a call, you just capture upside profit potential.
Or
And I effectively refuse to do that. It's always not the right choice. And again,
you
there's a
know
go ahead.
is it a lot of people trade the wheel sort of at a single strike premium. It sounds like you are selling a whole set of tenors. You're selling strikes down, meaning that you're not vulnerable to just getting underlying at one price. You basically, if the price is going to come down, I'm going to buy it at a whole mixed bag of prices to give myself a blended basis connection. Is that right?
Different strikes, different expirations. Most of the time, if something's falling, I'm actually adjusting the short puts until I'm at a point where I feel the market is slowed. So, what I do not allow is if the market is coming down fast and I have a short put that just got, broken through, I'm not
Yeah.
just going to take assignment here. I'm going to try to roll this thing and manage it as best as I can to maintain as much spot price sensitivity. Then,
Right.
if it looks like the stock is starting to level out and this
Right.
is just a little bit higher, great, take
Yeah.
assignment there. But I apply the same methodology as buying stocks. I'm not going to go long something that's going down. So I'm not going to take assignment on short puts if it's going down. I need
Right.
to see it stabilize. Otherwise, I generally speaking would rather stay in the puts because then I can adjust my basis through management.
Right. Yeah. You constantly adjusting your basis. You improving your basis
Yeah,
by rolling down, rolling down, rolling down. Yeah. That's interesting. Yeah. That's very
100%
good.
correct.
Come on. Yes. I'm sorry. I was interrupting you. You were saying that you were using all these different you're sort of using some ideas into the
The
speculative
core.
portfolio
Yeah.
and then into the core portfolio.
Yeah.
But
So
I was going to
go
ask you
ahead.
one other thing of the core. Is everything in your portfolio options derivative, or do you hold on the underlying as well? Like in a core portfolio, do you just hold like the S&P, the SPY, the QQQs?
Nope.
Huh.
Nope.
So
So,
so what do you hold in the core portfolio?
so the core allocation is generally trading the strategy we were just reviewing, the covered strangle,
Right.
in either index ETFs like that or in leveraged index ETF like T triple Qs, SSO, UPRO, so two times, three
Right.
times leverage, things like
Right.
IBIT, so Bitcoin exposure. So it's generally stuff that is some sort of ETF. I used to trade it in individual names, but as the portfolio has grown, I can get just better exposure and also a lot of times better premium on the put side of things because there's a lot of hedging going on.
Yeah.
Um, so a lot of times on the core, it'll be those kinds of things. Yeah. And
Interesting. So
then,
you're exclusively exposed to the market through the derivative market.
mhm,
Um, and but some of the strategies are sort of obviously much lower volatility. Other strategies may be a little bit higher risk, higher volatility. But um, you really, it's fascinating. You really use derivatives almost as a substitute for the underlying
mhm.
in the in this.
Literally doing that right now with a couple long plays that I have out. I'm holding options that are 500 days out. And what I'll do with those is I'll buy long options that are right at the money, slightly in the money as a stock replacement. They're going to have low gamma, so you need a higher delta. All that means is in order for me to benefit is the price moves in my direction. And then I'll sell short calls against it at a ratio to subsidize the carry cost of the theta decay.
Yeah, that's the Nancy Pelosi strategy, and
That's right.
she's earned 70% per year for like 10 years running, which is basically that's I was curious about that, like how you feel about we talked about zero DTE, which is the exact opposite of the much longer 1 year. You said 500 day duration. These are literally stock substitute positions. What's
Yep.
great about those positions, of course, is you're exposed almost one for one. Let's say, I don't know, zero 0.8 for one or zero 0.7 for one to the underlying on the upside. But if the stock crashes, or if there's a massive decline, there's only a stub of premium that you're holding. You're not holding a $300 stock. You're only holding like a $20 option against it, so you don't have that huge fall against you, and you can stand for days on end, in that position. If you were in the underlying, you might be down 50%. Like $150 on a $300 stock, whereas here you might be just $10 on the thing, and you could have the staying power for the thing to come back if the market re-rallies. Um,
Definitely. Yeah, definitely. And that's one of the most beautiful parts about options that I think is by the way, the reason why I keep repositioning is cuz your boy has a terribly herniated disc, so I just
okay.
reset.
So
Um
I'm sorry
yeah.
about that.
No, it's all good. It's just so that people aren't like, "Yo, what is
Yeah.
wrong with this dude?" Now you know what's wrong with this dude.
Uh,
Um But the other cool part specifically with options is that, like, they're super strategic. You
right.
can make it literally whatever you want. The risk reward profile that you want is there. So if
Right.
you want something that has the ability to compound a whole lot, there's a trade. If you want something that's going to serve as a cheaper stock replacement, there's something there. And exactly as you're talking about. Now, always there's a trade-off. There's always a trade-off. And it's super important to make sure that you're balancing both sides of the equation so that you can get what you want. But
Right.
there's a lot of really useful use cases for sure.
Yeah. Yeah. No, I mean, I think that's the number one lesson of trading, is that there's always a trade-off
Right.
in whatever you do. You have to understand that. And I think that's the part of becoming serious about trading, is when you begin to understand what the trade-offs are, and then accept those trade-offs as just part of doing business. Um,
100%.
Yeah. Well, yeah, we can talk forever, but we have to go. But I was going to ask you, where can people find you? Is there are you active on X? Do you have a website? Because I'm sure people would love to talk to you a little bit more about all the stuff that you're doing. How are you? Are you do you at all have a profile on social media?
Yeah. Yeah. So people can find me on YouTube at Outlier Trading. And then you can find essentially the same website, outliertrading.io. Those are the two main places.
So, what does outlier trading do? Let's talk a little bit about that. What is that YouTube channel all about?
It's really just information dump. So I started YouTube during COVID because I've become like an evangelist for a handful of topics. So it's like if you're around me, you're gonna hear me talk about fighting in some capacity, like jujitsu or something. I'm gonna talk about stuff. but the other one is always investing. I
Uh-huh.
think investing is a must literally for everybody. And a lot of my military friends, they're not going to have the time, the proclivity to become like traders, which I fully get. So in during COVID, I knew all of them were stuck at home. So I was like, yo, guess what? We're talking about money. And
Right.
so I would have conversations with them. Anyways, what ended up happening was I was repeating myself a lot, right? Like talking about the concepts of like an
Yeah.
emergency fund. A lot of them don't even know what that is.
Right.
So I was like, I'll make a YouTube. I'll record these videos from my laptop so that I'll send the links to my friends, be like, yo, watch this. And then we'll hop on the phone so that I can try to figure out where you're at and see if, we can change what you're doing so that it's a little more optimized.
Mm.
So that's how it started, literally just making videos for my friends.
Wow.
And over time, it just started getting more interest from other stuff, which was 100% not part of the plan. I actually have a hilarious YouTube video that I'll share in just one second. Um, and then it just morphed. So I started just talking about the stuff that I do, which is way different than the stuff it started with.
Right.
But I realized that there's a 0% chance I would be at where I'm at right now in life if I didn't have that high school teacher that took the time to even
Mm.
introduce the topic of investing to me.
Right.
There's a really good chance I wouldn't have found that for a while. Or I would have just done what most people in the military do, which is the TSP, which is not a great plan. It's not bad, but it was
Mm.
nothing special.
Mm.
So that dude, like literally single-handedly changed the entire trajectory of my life.
Wow.
So I view it as incumbent on me to at least offer that opportunity for one other person. That's essentially what it is. So it's to try to share some of the tools behind it. But the funny part about the YouTube that I just get a kick out of now, before I had the YouTube channel, was like a couple weeks. I had a massive swarm of bees outside my window. And I was like, gonna need a beekeeper because they're trying to set up shop in my house.
Yeah.
Beekeeper comes, gets rid of the bees. As he's leaving, he looks at me. He's like, "Are you like some sort of YouTuber or something?" And Boris, I had no social media presence my whole life. I thought that was the craziest thing somebody could have ever said to
He
me.
recognized you? He recognized you?
No, this is before I started YouTube.
Oh,
So I thought it was the most incredulous thing ever to do
uh,
YouTube. I was like,
one.
I don't belong on a camera. And like, I don't
Yeah.
like, I thought it was the craziest thing ever. So
Well,
not only did I start investing through that random dude in high school that introduced me, but apparently a beekeeper
so
planted the seed for
beekeeper
YouTube. Yeah,
like your movie too.
absolutely
That's
wild.
good. That's great. That's great. And yeah, and now I'm sure everybody should really go visit the channel because it's a wealth of it. We just scratched the surface of all of the stuff that Erik does. Really, really fascinating show, by the way, just in terms of the approach that you take, which is so much more sophisticated, so much more mature, I think, than a lot of what trading has done, which is again, have a hunch, bet a bunch. I love the fact that you handicap a lot of these behaviors, and I'm sure people who want to learn more about all of these social behaviors that translate into repeatable, actionable trading strategies. That's where they can find it in outlier trading, right? Um,
Beautiful.
so great. Thank you again. We're going to give you some relief for your back and let you get up and walk around. I want to thank you guys again. Be sure to follow us at Trading Battle, subscribe, tell all your friends so we can bring you more of this kind of great content going forward. I'm Boris Schlossberg. I'll see you guys in the markets. Over and out.